Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into Smith Wesson Brands, Inc., SWBI, a pure-play firearms manufacturer facing a classic cyclical challenge that defines its entire existence. SWBI is betting its successful operational shift and $16.3 million positive Q2 free cash flow milestone will bridge the low-growth cycle, justifying its deep value thesis despite acute political volatility and chronic litigation risk that exposes the sustainability of its $1.13 per share quarterly dividend.
That thesis, I mean, that really gets to the core tension of this company, doesn't it?
It really does.
Because in this industry, the top line numbers are just so volatile. The real fight here isn't happening inside the company. It's the market versus Washington, D.C. So to figure out if this is a real deep value play or if it's just a value trap waiting to spring, you have to look past the current sales numbers. You have to look at the big structural changes they're making.
And that current sales trough is, well, it's impossible to miss. Let's just start with the numbers from Q2 fiscal 26. The data confirms the slowdown is real.
Yeah, even if it's not a total collapse.
Right. Net sales came in at $124.7 million. That's down, 3.9% from last year. So not a huge slump on the top line.
No, but the fixed costs, they don't go away, so that's where the profit line gets hit hard.
Exactly. When sales slow down even a little bit, that operating leverage just flips on you. Their profit, the GAAP net income, it just dropped to $1.9 million.
Which is a staggering decrease. It's nearly 58% year over year. So you see sales just kind of drift down a bit, but profit gets absolutely hammered.
Yeah, that tells you they are deep in the downturn.
It does.
That's the classic head scratcher, isn't it? Sales dip a bit, but profit gets cut in half. Why would anyone look at that and see a deep value opportunity?
Because management is basically asking you to ignore all of that. At least for now. They want you to focus on the huge structural bet they're making. The move. The center of this whole strategy is the headquarters relocation to Maryville, Tennessee. And this wasn't just, packing up some desks. This is a complete consolidation of everything. Manufacturing, R&D, all of it.
Into a much more business-friendly state, we should add.
Yeah.
And this came with a huge price tag, right? The CapEx, the capital expenditures were massive.
Oh, massive. Around $160 million to build out that new facility. For a company this size, that is a huge, huge outlay.
So what's the payoff?
The payoff is supposed to be permanent, a structural advantage. Once that facility is fully up and running, management thinks the financial benefit will be profound. They're projecting it'll be accretive to their earnings per share.
Meaning it'll boost their profit per share.
Exactly. By 10 to 12 cents per year. Every single year. That's a permanent, baked-in tailwind that should, in theory, smooth out some of these wild cyclical bumps they always face. They're just building in efficiency for the next few decades.
It's a very strong operational argument against a pretty weak financial quarter. But you can't talk about Smith & Wesson without talking about the elephant in the room.
The volatility.
The volatility. Let's really get into the scale of the chaos here because it overshadows everything.
It is the defining feature of this industry. It's not driven by normal economic cycles, GDP or housing starts. It's driven by completely unpredictable political and social events.
Panic buying.
Essentially, yes. When new regulation is threatened or a specific event happens, demand just spikes. Incredibly high, incredibly fast. It's a cycle driven purely by fear of scarcity or restriction.
Which makes any kind of financial forecasting almost useless.
Yeah.
And the headwinds aren't just demand driven. There are structural costs hitting them no matter what.
That's a great point. I mean, just look at the tariff headwinds.
On steel.
On steel, which they obviously use a lot of. Management said that one factor alone has a 120 basis point negative impact on their gross margin just in the first quarter.
Okay, let's break that down for everyone listening. 120 basis points. That just means for every dollar they make in sales, 1.2 cents is immediately gone.
Eaten up by tariffs. Yeah, it's a guaranteed tax on every single product they make.
A frictional drag on their profits that they just have to absorb. And then you have to add the other constant pressure, litigation.
Chronic, pervasive. They're always managing these huge legal defense costs, and the risk is always high. And some of these threats are incredibly complex. They've got this putative stockholder derivative lawsuit hanging over them.
That sounds intimidating. What exactly is a derivative lawsuit?
So it's basically when a shareholder sues the company's management, but they do it on behalf of the company itself.
Yeah.
They'll allege some kind of mismanagement that hurt the company financially. And whether the claim has merit or not, it's just an enormous distraction and a huge drain on resources.
And that's not even counting their international exposure.
Yeah.
We know there's a Canadian class action suit that was certified back in June 2025. That's a real concrete liability they have to account for.
Which we will circle back to because it gets interesting. So you have the central conflict, right? Management is trying to build efficiency, but they're fighting these constant external pressures.
So their ability to survive really comes down to how well they execute when things are slow. How are they managing inventory and pricing power right now in the trough?
That is the key question. And the bull case, the whole deep value argument, rests on their operational resilience. They have to get through this without resorting to deep, deep discount.
Which kills your brand.
Kills your brand and your margins. And so far, they've done a good job. They seem pleased with their average selling prices. They didn't panic and just slash prices to move product.
And that brings us to, I think, a really crucial point, the health of their distribution channel. This is probably the best indicator of whether they're ready for the next surge.
It is, and the news there is actually very good. Distributor inventory levels are, and I'm quoting here, very healthy. The number of guns just sitting on distributor shelves actually went down by over 5% from the last quarter.
And what about from last year?
Down an impressive 15% compared to the prior year.
Okay, that's a really important piece of the puzzle. For the investor, what does a clean channel inventory really mean?
It means the system isn't clogged. See, when there's too much inventory out there, distributors start demanding huge discounts from the manufacturer just to clear it out.
The dreaded channel stuffing.
Exactly, and Smith & Wesson has avoided that. By keeping the channel clean, they are perfectly positioned to turn the next demand surge directly into shipments and high-margin revenue. The spring is coiled.
And it seems like they're using this slow period for more than just inventory management. They're pushing innovation.
They are. The data on this is actually pretty stunning. New products accounted for a massive 38.7% of their sales in Q2.
Nearly 40%.
Almost 40% of sales from products that are less than a year old. For a mature manufacturing company, that is. That's an incredible figure. It shows their R&D is actually working. They're creating their own demand instead of just waiting for political events to do it for them.
And to balance out that chaotic consumer market, they have the professional channel, law enforcement, and the military.
Which is their stability anchor. It's a much more consistent, reliable stream of revenue. That channel accounted for about 9% of their net sales in fiscal 2025. It's their baseline.
Their floor.
Yeah.
And they are really leaning into building that loyalty, which ties right back to the big Tennessee move.
It does. A key part of that new Maryville facility is the Smith Wesson Academy.
And what do they do there?
They provide free training to law enforcement and military customers, both current and potential ones. So this isn't just marketing. It's a long-term play to build institutional relationships. They get these departments familiar with their gear, they train them on it, and they become loyal, repeat buyers.
It's another example of management trying to build these little moats of stability around the business.
Yeah.
But while we're on these strengths, we do have to pivot back to a really critical risk they disclose themselves.
Right. On the governance side, this is where the legal and the financial worlds really collide.
You're talking about the warning on their accounting controls.
I am. The company disclosed a material weakness in internal control over financial reporting.
And that's specifically related to how they calculate legal expenses, right?
That's the one. Specifically, the accrual for legal expenses, how they set aside money for lawsuits.
Why is that so alarming? I mean, for a company that's always in court.
Because a material weakness is a formal admission that there is a reasonable chance a major error in their financial statements won't be caught in time. And when that weakness is tied specifically to legal costs, it means the numbers you're seeing for liabilities. You know, the money set aside for that Canadian lawsuit, they might not be reliable.
So they might not have enough cash put away to cover it.
Potentially. Management says they're working to fix it, but they don't expect it to be fully remediated until sometime in fiscal 2026. So for an investor, that requires some serious scrutiny.
Okay, so let's try to synthesize all of this. You've got this really compelling story on one side. Proactive operational efficiency, the huge tailwind from the Tennessee move, and clean inventory ready for the next cycle.
The spring is coiled.
Right, and that's pitted against these just relentless external forces. Political chaos, tariffs, constant litigation, and now this internal control issue over those very same legal costs. Do the operational strengths really justify the deep value thesis.
The financial vulnerability is still, I think, the main story. That high volatility in sales leads directly to high volatility in free cash flow.
Even though they had that positive $16.3 million FCF in Q2.
Right. But that cash flow is lumpy, it's unpredictable, and that volatility puts the dividend at risk. The whole thing. That $0.13 per share per quarter.
Which is the entire reason many people own this stock. If the dividend is at risk, the thesis collapses. You're no longer being paid to wait for the cycle to turn.
That's it exactly. If this downturn lasts longer than they think, or if those legal costs blow up because of that material weakness, that dividend is the first thing on the chopping block. It makes the stock a very high-risk bet that depends entirely on the timing of the next political catalyst. So ultimately, when you invest in a company like Smith & Wesson, you aren't really betting on predictable compounding earnings. You're not. You're buying a unique kind of instrument, really. You're using that quarterly dividend as compensation for waiting.
Waiting for what?
For the chaos to start again. It's a strategic bet on structural volatility.
Risk defined. Portfolio protected.